Welcome to TradeTheMBI's ongoing series on traditional indicators, trust and trade, or fear and stay clear. And in today's installment, we're going to go ahead and take a look at a very popular chart favorite, stochastics. Is it a friend of the trend, or is it a portfolio foe? And I think the best way to look at any indicator is to go directly to the language that makes up the indicator so we can understand the function behind it. In this case, we see that the inputs are very straightforward. We have a moving average. You're going to end up with an oversold and an overbought line, and then a fast moving average and a slow moving average. And so if we right click the actual stochastics function, we can go to TradeStation, gives us a definition. And we can scroll down through here and you can see that it's taking the high, the low, the close, a length, and then it smooths that, and you're in both a fast line and a slow line. And from that fast and slow line, stochastics will then cross over and cross below, and that will give us our indication of buy and sell signals. So if we go back to our overall language, we can see that it's basically saying that if the current bar is not just the beginning, that we then look for a crossover of the slow over the fast, and that you're oversold, and then you sell when you're overbought. So when I look at stock twits on a daily basis, that I go through tons of charts from various people, and I can assure you that one of the more popular ones, besides the MACD, typically right below it is the next one you find, stochastics, and there it is. So if we go to a regular chart and we begin to look at what this really is, the green lines represent the overbought and the oversold. So at the bottom, we would look to buy when we get the crossover of the blue line over the red, and then when it moves all the way back up in price above the green line, we look for the blue to cross below the red, and that will give us our sell signal. So fairly straightforward. So we might as well turn on a strategy that has that in there, and voila, it gives us the trade. And so right there we can see that it crossed over, went long with the long entry, and then went up above overbought, crossed below to give us our sell entry. So from that standpoint, it appears to be functioning correctly. So let's begin to take a look at the numbers. Wow. Decent win rate, horrible profit factor, basically just a money loser. The RINA index down there is at a negative, not a horrible negative, but still negative. If we look at some of the other statisticals, annual returns, choppy, not very consistent at all. Equity graph, that's just awful. I think that's probably the best way to describe that. And adverse excursion, just unpalatable. Nearly 45% drawdown in your account off of this kind of setup. So definitely not a daily setup. So if we go to a 60-minute, maybe we'll get a little bit better overall setup when we look at some of the details for that. And much better, 70% win rate there, actually profitable, 1.5 times. So that's at least decent. And we got an RNI of 16.9. So 60-minute, it's actually doable. It actually produces somewhat positive, even though a very limited number of trades for an entire year. Drawdown, unfortunately, is still rather high, 16%, 10% from the adverse excursion. So from a smaller time frame, we'll see if we get any improvement. Doing the same type of trade, and no, still a decent win rate, but it just kills you with the drawdown, and that RINA index still negative 66 is not going to get it done. Annualized returns, choppy. So no consistency there. You don't know what you're going to get year to year, and just a horrible equity graph there. You started out decent, and then it just falls off a cliff. 2007 period. Okay, so it does make sense, but needless to say, using the basis of the indicator really would be unattractive to be able to trade that setup. And those are just really large numbers for drawdown. So you'd have to have quite a strong stomach for that setup. If we look at a 5-minute. It's still buying at the correct spots and still selling with the oversold. So from that standpoint, everything is working correctly and functioning. So let's go ahead and take a look at the performance reports for a 5-minute and see if we get any improvement. And no, still holding on to a decent win rate, but that profit factor is awful. Annualized returns are going to be horrible on a 5-minute, and that equity graph, that's just not something you can trade and be able to sleep well at night. So a little bit less on the drawdown from a 5-minute standpoint, but overall, just not an effective way to trade. So if we look at typically what we do for fractal setups and get an idea of our overall profit targets and that, we're looking at a much better win rate, 70 plus, 2.5 profit factor, excellent ratio between our wins and losses, very consistent returns annualized, and an equity graph that is exactly what you're looking for, as well as minimal drawdowns. So definitely a stark comparison when thinking about utilizing fractal trades versus that. So in the quiz, is stochastics a portfolio friend or foe? Well, at the end of the day, stochastics is a portfolio killer. And there's just no other way to describe it with that kind of inconsistency. As always, though, trade well and look for a continuation of the series.